Hi, this is Dan Collins, Editor-in-Chief of Futures Magazine for Traders Exclusive, coming to you live from the floor of the CME Group. Today I'm going to talk a little bit about a subject that we've talked about in the past, managed futures and making sure that you have a diversified allocation in your investment portfolio. But the one important aspect of that is due diligence, and that is knowing who you are investing money with and knowing how much you're paying for it. Recently, the National Futures Association banned from membership the FCM Vision. They have 6 months to, they have a plan to transfer themselves in 6 months, and then they're going to reapply for NFA membership. But it was all related to them raising assets for a CTA called ACE Investment Strategist and its owner's Yu-Dee. The charges came down last September, and he was accused of taking more than $2 million of cash residuals. That's money extra from a kind of a split fill where they get one price and there's some excess over that. As part of the deal, he is banned from membership and has to leave in 90 days. But he's been around for more than a decade, and I wrote like 10 years ago about a strategist. Why do I mention this is that he's a popular figure. So when you watch these things, it doesn't, just because you see someone on TV that's not due diligence, that should not give you comfort, because this gentleman has been, a popular commentator on many business networks. Regardless of where you find someone, you have to do due diligence, and you have to know what their fee structure is. Not related to this problem, what ACE had done had a fee structure where brokers were able to charge a load fee in front of it. On the story, the break-even analysis on an investment in some of these strategies under this fee structure was up above 20%, which is just a ridiculously high hurdle for someone to make. So when you're looking to make an investment, talk to people, get recommendations, but look at all their disclosure documents, know what their fee structure is, know what the break-even cost is, know what they have to make before you start to earn money. Just because someone is recommended to you, just because you see somebody on TV, doesn't necessarily mean they're legitimate. Their strategy, if they claim to be low vol, that's not really good anyways, because sometimes that could add fees. If someone's extremely low vol and you want to earn more money, sometimes you're doubling that management fee by trading, having them trade for you at a higher leverage, at a higher gearing. So, high volatility is not bad as long as everything's exposed. Low volatility is not good, and it could add to your cost. So remember, always do due diligence on a manager, and look out for Futures Magazine and futuresmag.com. We're going to have a lot of great features on our upcoming 500th issue. We're going to bring in some stories from the past that have kind of stood the test of time. Some analysts who have created reports that it'll be good to revisit, like the Wells-Weiler RSI, and some of the strategies presented in futures in the early days, going back to our days as Commodities Magazine. This has been Dan Collins for Traders Exclusive. See you next time.